The Federal Reserve is expected to cut rates by at least 25 basis points at its meeting next week, September here, and midpoint of September. A lot of investors are excited because this could mean lower borrowing costs for businesses and consumers going forward. So, how big of an impact will this have on you and your credit card? Here with some answers, we've got our very own Kendall Little. Hey, Kendall, so what type of change should people ultimately anticipate here?
Yeah, so just to give a little bit of context, this period of higher interest rates has been tough for a lot of credit card holders. We've seen balances growing, we've seen delinquencies on the rise. Just last year, credit card total debt hit $1 trillion. And if we look at interest rates, back in 2022, before the current rate hike cycle, average rates were around 16%. Now they're closer to 21% and rising. And we've seen credit cards with APRs that are even closer to 30%. So all of that adds up to a pretty tough cycle for credit card holders. But the important thing to remember is that the Fed's moves are only one part of what determines your credit card interest rate. So, whether the Fed lowers rates by 25 basis points, by 50 basis points, historical data shows us that that probably is not going to have a very significant impact on what your credit card interest rate is.
So if someone has credit card debt, what should they do now before the Fed cuts rates?
Yeah, so today and every day is a great time to really start taking action to eliminate that credit card debt. Really make the moves that are going to start getting those balances down while credit card interest rates are high. One way that we really recommend and that we like is a balance transfer credit card. These credit cards offer 0% APR for typically between 12 and 21 months. So that means that you're going to have over a year with no interest charges on that balance. You can really work toward getting it down. You do have to think about balance transfer fees, but that 3% to 5% fee is really nothing compared to the interest charges. Another consolidation option for some people is going to be a personal loan. You're not going to find a 0% personal loan, but personal loan rates are typically much lower than credit card interest rates. So again, you can save on those interest charges. And then the last thing that you really should make sure you're paying attention to is stopping that overspending in its tracks. So while you're taking on, this period of paying down your debt, you don't want to add to the debt. So if that means starting to spend more with cash or using a debit card, you might forfeit some rewards, some cash back, but again, that's going to be a lot less of a hit than the interest charges that you would have.
Kendall, thanks so much for taking the time with us as well. This is going to be something major to track here. Lastly, maybe we can insert this into the chat just before we let you go. From credit cards to loans as well. I mean, how should people be thinking about their loan strategy right before this potential interest rate cut?
Well, I think it's going to depend on whether you have a variable rate loan or a fixed rate loan. So credit cards are variable, so that means that, the rate can change. But if you have a fixed rate loan, it might have less of an impact. But either way, the higher your interest rate is going to be, you're going to want to make sure that you're paying those down as quickly as possible.
Kendall Little, Yahoo Finance's own, always ready for any topic that gets her thrown her way. Kendall, thanks so much.
Yeah,
Appreciate
of course.
it.